Okay, one of the things that I hear people get confused about all the time is the difference between a tax classification and a financial vehicle. I'll hear people all the time say, "Oh, Rob, I know that's an IRA because it's a mutual fund." Well, that's not necessarily true. And let me explain the difference. Tax classifications. Some very common tax classifications are 401ks, traditional IRAs, and then also Roth IRAs. These are all qualified funds. The reason why is because there's a tax qualification attached. One of the other tax classifications is non-qualified, meaning there's not really a tax qualification attached to it. That's typically going to be associated with money you have over in your bank account or money that you've earned from your employer and it's already been taxed. Being CPAs, one of the most important things to us is we want to make sure we always know what the tax classification is of what we're dealing with. The reason why is because they can all be treated differently. Okay, now what I'm going to do is I'm going to talk with you about various financial vehicles. Many common financial vehicles that most people are familiar with are stocks, bonds, mutual funds, exchange-traded funds or ETFs, and bank accounts. Now you're always going to be pairing a tax classification with a financial vehicle. They're always going to be going together. Understanding how those pair up can make a big difference on building your wealth. So, for example, your IRA, you could have it in stocks or bonds or mutual funds or an exchange-traded fund, or you could even open up an IRA over in your bank account. Your Roth, it could be in stocks, bonds, mutual funds, exchange-traded funds, or even over in a bank account. Non-qualified, it could be in stocks, bonds, mutual funds, exchange-traded funds, bank accounts. Your 401ks, I typically do see those are just over in funds. Now, with that said, a plan should be dynamic. And part of that's going to be dependent on what our age is and what our short and long-term goals are. Each one of these tax classifications and financial vehicles, when paired properly, can make a huge difference in building your overall wealth.